Today we're going to continue with Jasmin's plight. As you'll remember, she starts out her year doing really well, and then by the end of the year, she doesn't have any business. So she ends up running out of money. Let's go over this quickly. So Jasmin's cash flow looks something like this. Beginning of the year, she makes a whole bunch of money, then nothing for the rest of the year. And then November, December, she has absolutely nothing left. So she's completely poor. She got a little bit of money here, but that was kind of to cover some debt and interest. These last 2 months, she was running on empty. She had absolutely nothing. So she was completely poor by the end of the year. And this was something that happened year after year with Jasmin because she got this money, which seemed like a lot at the beginning, and she spent it all during this period. And then she ran out of money for the rest of the year. So we were looking at different options that could help Jasmin really with her own spending problem. How could Jasmin stop her from spending all her own money? So a few things that we looked at was, number one, we looked at cash. And the issue with cash was that it was just too easy to spend. That was kind of the status quo. That was what Jasmin was dealing with to begin with. So it was too liquid. Then we looked at private equity. Maybe she could put a bunch of money aside in private equity, and that way she wouldn't have the ability to spend it. Because as we know, private equity is illiquid. The only issue with private equity, or the big issue with private equity, is that because it's illiquid, she has no access to it. So November and December comes around, maybe she's got $100,000 in her private equity investment. She can't access that money because it's not liquid. It's illiquid. Then we looked at stocks, and our issue with stocks was that they're volatile. In trying to fit a volatile income with a stock market that's also volatile can be very tricky. And then we looked at Bitcoin, and we had basically the same issue with that volatility. But even a little bit more pronounced with something like Bitcoin than the stock market, right? Then we looked at real estate. And real estate, if we just look at the asset again, it didn't work again because it was illiquid. So we looked at all of these, and we had big issues with all of these assets on how to manage this problem that Jasmin's got. So we looked at another element that might help us out, and that was adding in some debt. Well, what if I could borrow the money? Because with some of these things, these are really timing issues. Can we time the top of the market for the same time that we need the income? That's a timing issue. Again, with the real estate, hey, I've got all this value that I can't access. Can I use the debt to get that future value of the real estate when I eventually sell it? Can I get that future value right now by using debt to borrow against the assets? We found that the debt didn't really work. Of course, it doesn't work with cash. It does a little bit work with cash, but there would be no point because we can just take out the cash. So we'll say it doesn't really work with the cash. It doesn't work with private equity because who's going to lend against private equity? Not a lot of people. Not a lot of banks. So stocks, it didn't work because of the volatility. Because stocks can be volatile up and down, but we can also have the issue. So we have up and down volatility with the stocks, but that volatility doesn't really predict the direction of the volatility. It just says the asset's going to be volatile. So we may have it volatile where it goes down once, twice, 3 times, 4 times. We don't know how many times it's going to go down. So we can have pure downside volatility, which means that we get further into debt, further into debt, further into debt, until we're bankrupt or broke, right? So, same issue with Bitcoin. Because of the volatility, we couldn't really use debt to supplement the fact that we've got this volatility here. So real estate was a bit of an interesting story. We actually could use debt with some reasonable understanding that the real estate was not going to be as volatile. There's still a possibility for volatility. It wasn't going to be as volatile. And we can borrow a fair bit against real estate. So there were some issues in that the money could get trapped in the real estate and we may not be able to pay back the debt. Real estate can go down, but it was definitely a better situation than anything we'd encountered before. So we'll maybe give that a neutral. So what else is there in terms of assets? Well, there is something called a capital pool. So a capital pool is a modified insurance plan. And the way it's modified is where we usually think of insurance as being a big death benefit and a very small cash value. This one has a very small death benefit and a very large cash value. So what we're doing is we're modifying insurance to change it really into something more like an investment. So a capital pool is a little bit similar to real estate in that there really is illiquidity. So capital pool. So it is, generally speaking, illiquid. It's illiquid in nature, but the plan can be collapsed at any time and all that money can come out of it. So it's not illiquid like a private equity investment where you can't get the money. The problem is, if you want to get the money, you have to collapse the plan. If you want all the money out, you can take portions of the money out, but if you want all the money, you're going to have to collapse the plan. So in that sense, it's illiquid. But similar to the insurance, similar to the real estate, it can be borrowed against. The interesting thing about the capital pool is it does have a guaranteed value. So if we actually look at it like a little bit of a chart, capital pool, it's got that interesting Goldilocks quality that we talked about before, in that it's partially liquid, in that we could take all the money out at any time. And it's illiquid because generally speaking, it wouldn't be advisable to collapse the plan. So it's sort of that Goldilocks situation that we talked about before. It's guaranteed, like cash is. And we have a good growth rate. So from a lending perspective, it makes a lot of sense because what we were worried about was that slow or even quick decline in the real estate or a quicker decline in the stocks where it would lose all its value and we might go bankrupt, right? Or even in the case of the real estate where we weren't able to sell the real estate because there was no liquidity in the market. This one, because it's guaranteed, we know we're going to stay above water. So we know 100% that we're going to have that money in the future to pay back the loan if we need to. And we're also in the situation that if we need to, we can collapse the plan at any time to pay back the debt. Also, because we do have a growth rate, we know that we have a reasonable expectation anyway that we are going to actually increase beyond the rate of inflation. And capital pool, which was different than the cash, where our cash was kind of staying level and our expenses were increasing over time. So with the capital pool, we are in a similar situation to the real estate in that we've got a good rate or a good loan to value that we can borrow against. And we have a good idea that in the future, we're going to have the value that we have today. So we managed to retain that capital value. And we can actually get 100% loan to value against it. So that means for every $100,000 we have here, we can borrow $100,000 back out. So in terms of our ability to borrow, we're in a similar situation to the real estate, but even somewhat better because of those guarantees and because of the increased liquidity that we've got there. So if we look at her problem again, if we look at Jasmin's problem, and we look at the problem that she's got $300K early, she's maybe got 50,000, or we'll call it 60,000 here. We're now able to manage that. Again, we're going to look at some more sophisticated solutions in the future, but just on a real base level, it seems like with the insurance or the capital pool, we are able to solve that problem. We can take out the capital pool here early in the year and later on, and we're not likely to take it out because we can take out a portion, but we're not likely to take out the whole thing because we would need to collapse the whole plan. So that's not stopping Jasmin necessarily from doing so, but what it's doing is it's adding friction to her doing so. Remember, the cash was so liquid, she could just use her debit card anytime she wanted to pull the money in and out. For this one, she is going to have to contact the insurance company, let them know that she no longer wants the plan, pull all the money out. The whole thing is probably going to take about 2 weeks, which gives her some time to have some sober second thought about whether she wants to take it out or not. So that added friction really is the key to making this work for her. So again, I don't think this is necessarily the full strategy that Jasmin needs. It wasn't everything that we did for Jasmin, but this is going to really form a pillar for us, having that stable foundation for the rest of her plan. So if we looked at her plan like a triangle, really what this does is it gives us a foundation. What is that foundational asset that we can put into someone's balance sheet to make sure that they're always okay. And then we can look at what's here. Let's put a question mark, because that's what we're going to consider in the next few weeks. We've got our foundation. This is something really that can anchor our whole plan. Well, how are we going to start bringing in other options into that plan? We'll talk to you tomorrow.